Today, the U.S. market is sending mixed but very important signals, and if you only look at prices, you'll miss the real story. The S&P 500 and QQQ are trying to stabilize after recent volatility, while the 10-year Treasury yield is moving higher again, and that's where the real pressure is coming from. In this video, we'll break down what's happening with SPY and QQQ, why bond yields are back in focus, and what this combination tells us about short-term market direction. Let's start with the most important chart today, the 10-year Treasury yield. We can see TNX pushing above the 4.20% area, continuing its upward move. This matters because rising yields tighten financial conditions, even without new rate hikes. The bond market is clearly saying inflation risks are not fully gone. The Fed may stay restrictive longer than equity traders want, and rate cuts are not guaranteed in the near term. Every time yields move up like this, growth stocks feel the pressure first. Now let's look at QQQ. We saw a sharp drop earlier in the session, followed by a partial rebound, but notice something important. This bounce looks reactive, not aggressive. Buyers are stepping in, but without strong conviction. That tells us institutions are cautious. They're defending levels, not chasing upside. Why? Because tech valuations are still sensitive to yields. As long as TNX stays elevated, upside in NASDAQ remains limited. This is a classic environment where short-term traders play bounces, but long-term money waits for confirmation. Now let's shift to SPY. Compared to QQQ, the S&P 500 looks more stable, and that's not accidental. SPY benefits from more defensive sectors, less dependence on long-duration growth, and broader market participation. The dip we saw earlier was bought fairly quickly, suggesting strong support below, but also clear hesitation near resistance. This tells us the market is balanced, not bullish or bearish, it's waiting. Put all three charts together and the message becomes clear. Bonds are warning, financial conditions are tightening. NASDAQ is vulnerable, yields are the main risk. S&P 500 is holding, rotation, not panic. This is not a crash setup, but it's also not a breakout environment. The market right now is pricing uncertainty, Fed policy, inflation expectations, and upcoming data. Going forward, the key levels are simple. Watch TNX, yields dictate direction. Watch NASDAQ leadership, tech will move first. And watch SPY reaction to dips, that shows real demand. If yields cool down, equities get breathing room. If they push higher, expect more volatility. That's the market today, cautious, reactive, and waiting for a catalyst.